Hey guys, what's up? I'm Erin and welcome back to the channel. For the past few weeks, your headlines have probably looked a lot like mine, screaming bank turmoil, bank crisis, or bank panic, or some version of that language. And let me tell you, I am not impressed. Welcome to the video I didn't even want to make, and you can probably tell because all of this started weeks ago and I didn't make a video on it. However, without fail, every time I post a new video, I get comments from people saying, "What do you think about what's happening in the news?" Or my husband even turned to me and asked me to make a video on this. So here we are. We're gonna do it, but we're still gonna make it good. All of this is in response to the widely publicized failure of Silicon Valley Bank, or SVB. And the typical narrative about it goes something like this. The failure of SVB was the largest of any bank since the 2007-2008 financial crisis by assets, and the second largest in US history behind that of Washington Mutual. And if we look at the timeline for the past few weeks, we see that 4 banks in total have failed. Silvergate Capital, SVB, Signature Bank, and there's a 5th bank in murky water right now, and that's First Republic. Hearing about multiple bank failures is terrifying, and understandably so. And when you hear about the largest bank by asset class, and that is an important distinction, failing, or the second largest in history, it is purposefully meant to unnerve you. While those statements are true, they're not telling the whole truth. They're telling just a small piece of it. First of all, let's consider why SVB was considered largest by asset class. The typical customer at SVB was not your typical bank customer. This bank catered to the uber wealthy, private clients, angels investors, that group. So much so that 85% of the accounts at SVB exceeded the FDIC insurance limits. The FDIC limit is $250,000, so having 85% or so of your clientele exceed that limit is not a normal stat. If you go to your local bank, the traditional consumer is going to be well within those FDIC limits. So this clientele here was kind of unique. They were quite wealthy, and that put this bank into a higher asset class, not necessarily that they were a large bank. And let's touch on bank failures for a moment. You have to remember, banks are a business, and if businesses are not managed appropriately, they fail. You might be thinking, well, banks have to be different. Banks just don't fail, right? Well, not so fast. The 2008 financial crisis and the subsequent years that followed ushered in a whole slew of bank failures. 25 in 2008, 140 in 2009, 157 in 2010, 92 in 2011, 51 in 2012, and 24 in 2013. That's a lot of banks. And maybe that suggests that bank failures are more isolated towards those recessionary times. Again, not so fast. Since 2001, so the past 23 years, there have only been 5 years where no banks failed. In fact, since 2001, according to the FDIC, there have been a total of 563 bank failures. Now, I'm not trying to trivialize the situation, but I'm just trying to say that it's not unheard of. Bank failures happen, and that's why we have FDIC insurance. A little breakdown of FDIC insurance. The FDIC insurance covers depositors up to $250,000 per institution in the unlikely event that banks fail. Those accounts that are covered are really those cash at the ready accounts. Think savings accounts, checking accounts, CDs, things like that. I will include a full list from the FDIC website. Account types not covered would be investments. Think stocks, bonds, mutual funds, life insurance, annuities, and notably, T-bills. A quick comment about T-bills, they are still incredibly safe. They're simply not held at banks, so they're not subject to this insurance, but they are still backed by the full faith and the creditworthiness of the US government. The FDIC insurance applies to banks only, doesn't even apply to credit unions. Credit unions are covered by the National Credit Union Administration, NCUA, which has the same parameters as the FDIC, making your money with credit unions just as safe. Now let's talk about that $250,000 limit. First of all, worth noting, the FDIC actually honored deposits in excess of $250,000 at SVB. If you have an account with your local bank that has an excess of $250,000 in it, it may have FDIC insurance coverage in excess of $250,000. It depends on the account type and the beneficiaries listed. To find out if your account account is covered, you can go to the FDIC website, use their EDIE calculator, and find out if your account is fully insured. I went through, filled out this form using a hypothetical trust that had $500,000 in it with 2 beneficiaries. The result is that the full $500,000 was in fact insured. So if you're curious, I will link that calculator down below. So if a bank fails, what happens? The FDIC steps in. They take over the bank and they establish bridge accounts that allow the customers to have full and uninterrupted access to their funds. The FDIC usually establishes these funds within 1 business day of a bank failure. No depositor has ever lost a penny of insured deposits since the FDIC was created in 1933. So that FDIC insurance really should have you feeling secure. And let's go back and read the top line on that page. The FDIC is an independent federal agency created in 1933 to promote public confidence and stability in the nation's banking system. The entire banking system is based on trust. When we put money into the bank, whether it's into a savings or a checking or a CD, we trust that it will be there. Period. End of story. Whether we want to get at that money next week or next year, we trust that it will be there. The system only works if there's trust. And if you don't have trust, then you have people who aren't willing to use these institutions and instead keep cash on hand. Maybe they put it under their mattress, maybe they put it in a coffee tin or hide it somewhere else around their house. And shame on the media for trying to damage this trust, for trying to make people panic. I know it's just what the media does, but on this subject, it feels so wrong and it is so frustrating. Shame on CNBC for doing a several-hour broadcast on this topic on a Sunday night, prompting my 71-year-old mother to call me and ask if her money is safe at her bank. Yes, it is. And shame on the other media outlets printing misleading headlines meant to invoke fear. And while we're at it, shame on those YouTubers that are putting flames in the background of their thumbnails saying the whole system is collapsing. Shame on you. I'm wildly disappointed. It's all being blown out of proportion. But let's get to the crux of it. How does it affect you? Because honestly, that's all any of us really care about. Well, by and large, it doesn't. There are over 4,000 banks with the US, and the vast majority of them are perfectly fine. And in the event of a bank failure, the FDIC steps in. Which brings us to our first point. Make sure that you're banking at an institution that is FDIC insured, or if it's a credit union, NCUA insured. Don't bank at an institution that doesn't have this insurance. Odds are you're never gonna need it. But don't bank without it. It's an added layer of protection. Think of it like life insurance. You're probably gonna live a nice long life. You're probably not gonna pass away early, but it is an added layer of protection for your family if something ever happens. Know the limit, $250,000. And if you have an account that exceeds this limit, why not switch it up a little bit? Leave $200,000 at one institution and move $150,000 to another. It just makes sure everything is fully protected. And if you have these high value accounts, just make sure to double check them with the EDIE calculator. I recently made some videos on CDs or high yield savings accounts paying alluring interest rates. And some commenters have asked, have my feelings on these account types changed in light of recent events? And absolutely not. If you have cash right now, you deserve to be getting a decent interest rate on it. Why not take advantage of these accounts? Use CDs, use high yield savings accounts, use T-bills. It sure as heck beats getting next to nothing in a traditional savings account or keeping that cash at home, just watching its value be eroded by inflation. If you can't tell, I still believe in the banking system. Speaking of capturing a good interest rate, you might have noticed that in the wake of all of this news, interest rates on T-bills and CDs and high yield savings accounts took a hit. They're still pretty decent, but they're not as high as they were 2 weeks ago. But I'm betting this is a temporary dip because the Fed just increased rates again, as they're still battling higher inflation. So as the Fed continues to raise rates, we'll likely see the rates come back up. Not only did the rates on savings vehicles take a hit, so too did those on mortgages. So if you're in the market for a mortgage, now might be a good time to lock in a slightly better rate. But just be mindful that it's probably only temporary. Right now, the banking industry is in the spotlight. And if you're in the market for a loan, it could make it harder to get. During the hard times, banks often resort to using a more strict criteria when assessing clients. And finally, these banking events could make that recession more likely. That's kind of a hard statement to make. The official verdict is we are not in a recession, but it kind of feels like we're in a recession. It kind of feels like we're splitting hairs at this point. Our economy is just in a wonky state. GDP is negative, stock market is down, inflation is high, but so too are the employment stats. If regional banks become more conservative about who they make loans to, it could spill over to less demand, less sales, and a slowing of economic activity. Is it serious enough to cause a recession by itself? I would think not. Banks have underwriting standards, which help determine who they lend money to. But if they become concerned about the risks of lending and make it harder for businesses and individuals to borrow money, it could contribute to a recession. Oxford Economics predicts a mild recession will arrive later this year, mostly due to the Fed being too aggressive in raising interest rates. Right now, households, corporations, and local governments are flush with cash. That should help limit the severity and the duration of the recession. The most important takeaway is that banking is still safe. Just make sure you're with an institution that is fully insured and keep in mind that limit of $250,000. We're going to continue to see some play with interest rates in the marketplace. But that's just what we've been seeing anyway. And maybe this event caused that looming recession to draw ever near. But at least they're still saying that it should be mild. All in all, I think everything looks the same. What do you think? What do you think about all this banking news noise? Let me know your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.